This is Dollar Logic, where we break down the hidden logic behind money, business, and the systems that shape your everyday life. No jargon, no fluff, just clear answers. You pay a premium every single month, hoping the whole time that you'll never actually need to file a claim. It's one of the strangest financial products most people own. You're essentially paying for something you hope never gets used. So how do insurance companies stay profitable if their entire business model is built around paying people back? Today we're breaking down exactly how insurance companies actually make their money. The foundational concept behind all insurance is risk pooling. An insurance company collects premiums from a very large group of people, most of whom will never file a significant claim in any given year. That collected pool of money covers the smaller number of people who do experience a covered loss, a car accident, a house fire, a medical emergency. Because the company can predict, fairly accurately across a large enough group, roughly how many claims to expect and how large they'll typically be, it can price premiums to cover those expected payouts while still leaving room for profit. This prediction process is called underwriting, and it's handled by actuaries, professionals who use statistics and historical data to estimate risk. Underwriters look at factors specific to you, your age, your driving history, your health, the condition of your home to estimate how likely you are to file a claim and how large that claim might be. This is exactly why two people can pay very different premiums for what looks like similar coverage. The underlying risk each of them represents is genuinely different. A key metric insurance companies track is the loss ratio, the percentage of premium dollars paid out in claims compared to the total premiums collected. If a company collects $100 million in premiums and pays out $70 million in claims, its loss ratio is 70%. Insurers aim to keep this ratio low enough, alongside their operating expenses, to leave a genuine underwriting profit. Though in some years, particularly with property insurers facing major natural disasters, claims can exceed premiums collected entirely. This is where the second, much less visible profit engine comes in, float. Between the moment a company collects your premium and the moment it eventually has to pay out a claim, it holds a large pool of cash, sometimes for months, sometimes for years, especially with life insurance. Insurance companies invest this float in bonds, stocks, and other assets, generating investment income on money that technically still belongs in a sense to future claimants. For many insurers, especially larger ones, this investment income is just as important to overall profitability as the underwriting side of the business, sometimes even more so in a strong investment climate. This two-part model, collecting predictable premiums from risk pooling and earning investment income on the float in between, is why an insurance company can be profitable even in a year with a high loss ratio, and why some insurers are willing to accept a modest underwriting loss if their investment returns more than make up the difference. Different types of insurance apply the same underlying logic in slightly different ways. Auto insurance prices around driving history, vehicle type, and location. Homeowners insurance factors in the home's age, construction, and local disaster risk, which is part of why premiums have risen sharply in regions prone to wildfires, floods, or hurricanes. Health insurance pools risk across a large group of enrollees, spreading the cost of expensive medical events across everyone paying premiums. Life insurance relies heavily on actuarial life expectancy tables and long investment horizons on the float it holds. Reinsurance is another piece worth knowing about. Insurance companies themselves buy insurance from other, larger reinsurance companies to protect against catastrophic losses that could otherwise threaten their ability to pay out claims, like a major hurricane hitting an entire region at once. This layered system helps keep the overall insurance industry stable even when individual disasters are enormous. So what does this mean for you as a customer? Since premiums are priced around your individual risk profile, improving factors within your control, like maintaining a clean driving record, improving home safety features, or bundling multiple policies with one insurer, can genuinely lower what you pay. It's also worth remembering that a higher deductible typically means a lower premium, since you're agreeing to absorb more of the smaller, more predictable losses yourself, letting the insurer focus its payouts on larger, less predictable events. Insurance can feel like a one-way transaction when you're the one writing the check every month. But underneath it, it's a carefully calculated system built on spreading risk across large groups of people and earning steady investment returns along the way, which is exactly how an industry built around paying people back manages to stay profitable, year after year. That's how it actually works. Understanding money doesn't have to be complicated, it just has to be explained clearly. If this helped, subscribe to Dollar Logic for more videos that make sense of the systems around your money. See you in the next one.